£85,000. That's the exact point where your safety net from the bank quietly disappears, and most people don't find out until it's already too late. If you've got savings sitting in one account right now, some of that money might not be as protected as you think. And before you switch off, stay with me until the fourth point, because it's the one almost nobody has heard of, and it could be quietly changing how much tax you pay without you ever being told. I'm Claire, and I spent years working alongside high street banks helping ordinary savers make sense of exactly this kind of thing. Banks won't call you to warn you about any of this. HMRC won't either. The whole system runs on the assumption that you already know the rules, and most people simply don't. There are 5 checks every saver needs to make, and I'm going through them one by one. Some of these could be costing you hundreds of pounds a year without you realizing it. Others could mean your money isn't protected the way you assume it is. So let's start with the one that catches out the most people, completely by accident. Here's the first check. It's about the FSCS, the Financial Services Compensation Scheme, and it protects your savings up to £85,000 per person per banking license. That last part is the bit that trips people up. Many savers think spreading money across 2 or 3 accounts automatically means it's all protected separately. Often, it isn't. Several well-known banking brands actually sit under the exact same banking license. So if you've got £40,000 in one account and £50,000 in another, and both belong to the same license, you don't have £90,000 protected. You have £90,000 combined with only £85,000 covered. That's £5,000 sitting completely outside protection, and you'd have no idea unless you checked. This applies to you if you've got savings spread across more than one account, especially if you open them at different times or through different apps. What could it cost you? If that bank ever ran into serious trouble, the amount above £85,000 simply wouldn't be guaranteed. So here's what to do. Log into your accounts today and find out which banking license each one sits under. It's usually written in the terms and conditions or on the FSCS website. If you're not sure, call your bank and ask them directly, could you confirm whether my accounts are covered under the same banking license? That one sentence could protect thousands of pounds. Now here's a question worth sitting with for a second. If your money is fully protected, is it actually working for you? Or is it just sitting there losing value quietly in the background? Because that's the second check, and it's one almost nobody notices happening in real time. Inflation doesn't take your money away. It just makes it buy less. A pound sitting in a low-interest current account today won't stretch nearly as far in a few years. It's not dramatic. There's no single moment where you notice it, but it adds up. This applies to you if you're holding a large cash balance in an account that pays little to no interest, particularly if it's been sitting there untouched for years out of habit rather than choice. The cost isn't always in pounds lost, it's in pounds not gained, which somehow feels less urgent, but hits your future spending power just as hard. Review the rate you're actually getting, compare it against inflation, and don't be afraid to keep some money as accessible emergency cash while moving the rest somewhere that actually works. Do this once a year, not once a decade. That inflation problem connects directly to something even more immediate, because while inflation eats away slowly, this next one is money you're losing every single month right now, and it's often a much bigger number than people expect. Let me introduce you to Joan. Joan's in her 60s, sensible with money, and she'd had £20,000 sitting in the same savings account for almost 8 years. She assumed it was earning a decent rate because that's just what the bank had always paid her. When she finally checked, she was earning just 1%. That's £200 a year. A newer account, still completely safe, was paying 4%. That's £800. The difference? £600 a year, every single year, just for not checking. Joan isn't unusual. Banks very rarely ring existing customers to offer them a better rate. They simply don't have to, because most people never ask. This applies to you if you've had the same savings account for more than 2 or 3 years without switching. Go and check your current rate today. Compare it against what's available elsewhere. And if it's lower, move it. It takes minutes. And for many people, it means hundreds, sometimes thousands of pounds back in their pocket every single year. Now, this is the one I told you to wait for. It's the one that almost nobody talks about because most people don't even know it's happening in the background. It involves your tax code. Here's the thing many people don't realize. HMRC doesn't always wait to see how much interest you've actually earned. Sometimes it estimates your future savings interest in advance and builds that estimate directly into your tax code. If that estimate is too high, and it frequently is, especially after interest rates change, you could be paying more tax than you actually owe, month after month, without a single letter explaining why your take-home pay looks slightly different. This applies to you if you have savings generating meaningful interest and you've noticed your tax code changing, or if you simply haven't checked it in a while. What could it cost you? Potentially a real ongoing overpayment that HMRC will only correct if you ask. So check your tax code, compare it against your actual savings interest, and if something looks off, contact HMRC directly and say, I would like HMRC to review the savings interest estimate in my tax code. That sentence alone has corrected genuine overpayments for people who never knew to ask. So we've covered protection, inflation, and interest, and now tax. But there's one more piece that ties all of this together, and it's less about numbers and more about how your money is actually organized. This final check simply asks, should all your savings really be in one place? This matters most if you've recently inherited money, sold a property, or built up a larger cash balance than you're used to managing. It's not about chasing the highest possible return. It's about reducing risk and making your finances easier to keep track of. The benefit here isn't always measured in pounds. It's peace of mind, better protection under the FSCS limits we talked about earlier, and fewer chances of losing track of an old account earning next to nothing. So sit down, list every account you hold, check the protection limits properly this time, compare the interest rates side by side, and decide honestly whether things need to change. So here's where all of this leaves you. It was never really about how much money you should keep in a bank account. The real question is simpler than that. Is your money protected? Is it earning a fair rate? And is it organized in a way that actually works for your life? Because doing nothing, just leaving things exactly as they've always been, can quietly cost hundreds or even thousands of pounds over time without a single warning sign along the way. To recap quickly, check whether your accounts share a banking license, check whether inflation is quietly outpacing your rate, check whether you're stuck on an old low-interest account, check your tax code against your actual savings interest, and finally, check whether your money is organized sensibly across the right number of accounts. If you know someone, a parent, a grandparent, a friend, who's been sitting on the same savings account for years without checking it, send them this today. It might be money they're already entitled to and simply don't know it. And if you'd rather not miss the next update before a deadline or a rate change catches you out, subscribe now so you hear about it before it happens, not after. Because the savers who come out ahead aren't the ones with the most money. They're the ones who actually checked. I'm Claire, and I'll see you in the next one.